Wait, what's this? Wait until you turn 50, son. Yeah. Turn 50 in August. AARP.
They've already started that. I think that's it.
Oh, you get discounts. Their membership has its benefits. Council, you ready?
Hello, yes, we can proceed.
Okay. Yeah, we were talking about AARP benefits. Oh, we got that. Miss Jill. So we've got a double feed again. So give us a second. And we may be logging out and starting back over. What I don't want to hear is me talking twice. Test. Okay, we're good. All right. Let's go ahead and call this meeting to order. This is the City of Palatka Police Officers Retirement Plan meeting for September 20th, 2022. Roll call. Here. Here. Here.
Greg Cummings, he said he would be absent. We do have a quorum.
All right, show James Norwood and Greg Cummings excuse absences. Okay, has everyone had an opportunity to review the minutes from our last meeting, June 21st?
Yes.
I'll entertain a motion at this time if there are no corrections or exceptions.
Motion to accept.
There's a motion on the floor in a second. All in favor, say aye.
Aye.
Opposed, motion carries unanimously. Moving on to our Capital City Trust report, Dwayne Madron.
Good afternoon, Dwayne Madron, Capital City Trust. I think you may have in front of you a book that looks like this with the blue stripe on it, and it's up there on the screen. So we'll go over the policy stance as of September 9th. So overweight cash because I reduced equity a little bit a few weeks ago, and I'm holding cash until things settle down. Overweight, large cap, underweight, large cap equities just a little bit, and underweight international equities. Due to a lot of reasons, business conditions here are better than they are over there. Our companies in our S&P 500 index, I feel, are better companies. The dollar is strong, which can help U.S. equities. It also can hurt. But in general, the Ukraine war affects international more than it does the U.S. So for now, I'm staying underweight international. I'm trying to stay neutral to the strategic model as much as possible. Currently underweight private real estate because it hasn't been funded yet, and overweight fixed income because some of the money to fund private real estate will come from fixed income. So trying to stay going forward, I'll probably be overweight U.S. large cap and underweight international for some time, although it can change. Any questions on the stance, the policy stance? If not, we can go on to performance for the second quarter. As you know, rising inflation and rising interest rates have hurt returns. This has been a bad year for stocks and bonds. The last quarter, the fund was down 14%. Equity was down 15%, outperformed the S&P 500, however, although not by much. High yield bonds were down 8.69. Real estate was down 15. So it's been a bad quarter because we started to enter a bear market. During the second quarter, US GDP declines 1.6%. The first half of this year has been the worst equity market in 50 years and the worst bond market in 30 years. I feel like things can't get any worse. The Ukraine war has exacerbated a lot of this. We have wage inflation, we have recession worries. The only bright side is that the economy unemployment's fairly low, 3.6%. So, at least a lot of people are not out of work. A lot of people still have a job, although their wages may not be what they want. So I just stop there and see if there's any questions on the second quarter. June and April were bad months. May was a good month. So just not a lot of positives to report. Every now and then we're going to have a bad year, and this is one of them. If you turn the page, you can see the returns through July. July was a great month, about a 9% relief rally or bear market rally. So year to date, July, the fund is down 13%, and the last quarter was minus 0.79. But if you look back over the 3 and 5 years, 9.7 per year, 8.7 per year, this is on the equities, not the equities and the bonds. So the equities have been doing good over the longer period, even though we've had a 20% pullback. Equities, longer term returns are still not bad. Hopefully, the Federal Reserve will stop raising rates in January, and maybe the economy can do better in 2023. So no questions. We can go on to the asset allocation section, which is just a snapshot of the account on September 9th. Fiscal year equities, my estimation is it's down 20%, still another week or so to go in September, but equities are down 20, not good. So it most likely will be a negative fiscal year because bonds are also down. So on this page, September 9th, your equities are 57.78, which is a moderate growth stance. It's not aggressive. Fixed income is at 28%, cash is at 8%, and real estate's at 5%. And the following pages are a listing of the low-cost mutual funds that we use, the Vanguard funds and the Fidelity funds, which actually have no fee. Then you see the Sawgrass fund. It has a slight loss because as interest rates go up, bond prices go down. Same with the high yield bonds. And then real estate, since inception, still has a big gain. So that's done well. So the nice thing is that you use a smoothing technique. So 1 year doesn't really destroy you because you average it over several years. So I'll just stop there. If there's no questions, that concludes my comments.
Any questions? Seeing no questions, I entertain a motion to accept the report.
I motion we accept the report as presented. Second.
There's a motion on the floor in a second. All in favor, say aye. Opposed, motion carries unanimously. Thank you very much, Mr. Madden. Next up, BCA. Mr. Chambers.
Yes, sir. I was gonna ask you how you like that LSU quarterback. Did you watch him?
I've watched him previously. Still, the jury's still out.
Okay, so we have a new investment policy, it was adopted last time. And we went ahead and moved forward with doing the due diligence for a private real estate manager. There's a 7% target allocation pending your approval today. The plan attorney was very helpful along with Jill in getting the documents, the side letter and so forth put together. So if you choose to go ahead with a private real estate, which I recommend today, everything's in order for you to go ahead and move that forward. I'll go over the report first and kind of give you a little backdrop. Background, page 1. I think Dwayne kind of softened you up on this a little bit already, but we have had an unprecedented year, since January, and that both stocks and bonds have lost money, significant amounts of money. Both bond and stock markets are down this year. And it's the first time since 1994 that we've seen stocks and bonds move downward together like that. Stocks and bonds generally move in opposite directions. There's the offsetting risk factor that bonds offer equities, but because of the Fed's tone and obvious actions to slow the economy down through raising rates, that has muted the bond market and certainly muted the stock market. So let me put things in perspective for you on page 1. I know you all are busy stamping out crime, and you may not see this from our perspective, and that's why I'm here to kind of help you. But the amount of money that was drilled into the economy since the COVID pandemic began is over 7 trillion. We went from around 23 trillion to 30 trillion in the national debt. That money has to go somewhere, and it's in the system. It's now created a massive amount of aggregate demand that wasn't, I don't think anyone had any idea we'd have this much aggregate demand. So the economy as measured by the gross domestic product has been growing at about 1.4 times the 40-year average. Now that's quite a statement. That's the nominal GDP. But when you subtract away the rate of inflation, you get the real GDP. That's the number you see on television. Based on these two complementing each other, we've had a no growth economy now for 2 quarters, first quarter and second quarter. But on a nominal level, it's booming. You see it in your driving. You see all the cars and trucks on the road. You see prices going up everywhere you look. So we clearly have a very strong economy. And the Fed is going to try to slow this down. You think the economy is slowing down now? Do you see it? No, it's not slowing down. Here's something interesting. Remember the PPP money that they doled out to keep people employed? I mean, I got a bunch of it. I hired 2 people during the pandemic. The airlines got $50 billion. You know what they did with the money? They bought out contracts. They furloughed pilots and they bought out existing contracts. They reduced the size of the airlines personnel with PPP money. Now the Justice Department's looking at this and something's going to happen there. So the airlines got caught flat-footed here, and now we have good luck trying to fly anywhere right now. They don't have enough pilots. They cancel flights. They don't even have enough equipment. So it's going to take a while to get through this. And here's something interesting. During the 1970s, the dollar collapsed. We had a huge amount of inflation because we got off the gold standard. The Fed chief that was finally appointed by Jimmy Carter, president at the time, who went into the Reagan period, started raising interest rates very rapidly. And what that really did was salvage the dollar, because much of the inflation was coming from a collapsed dollar. Well, right now, we have a very strong dollar. It was strong going into the pandemic, and it's gotten even stronger. The dollar is at a 25-year, 30-year high against the sterling, the pound, the euro, the yen. It's a great time to go to Europe. But that is going to be devilish on world economies. And so what reason I'm mentioning this is, I don't think the Fed's can raise rates much more. They're probably going to do 0.75% tomorrow, which will bring the Fed funds rate up to 3.25. Some people think they're going to take the Fed funds all the way to 4.5 next year. But I think the Fed's in a corner. I don't think they can do much. The reason I'm saying that is it may be good news, and that these rapid increases may be slowing down sooner than we've been told. And that'll be good for the stock market, and that'll be good for the bond market, and that'll be good for this pension plan. The reason why we're going to talk about private real estate is it is an asset that is very sensitive to inflation. And the problem we have right now in the real estate world, commercial real estate, is the high replacement costs, high material costs, rising labor costs, lack of labor. And this is driving up the value of commercial real estate. And I think there's a way to play that, and that's why we're going to get into that in just a minute. On page 4 are the summary remarks. I should mention to you that, and I applaud Dwayne Madden for the underweight to international. All of your peers around the country have at least, on average, about an 18% allocation to international. But international has underperformed domestic stocks for 14.5 years now. And it's one of the, if it's maybe the longest period of underperforming U.S. stocks. And we went all the way back to 1971 when we did that evaluation. So this is a long run of U.S. stocks outperforming. Do you have any idea why U.S. stocks have done so much better? Well, I'll give you a hint. In 2020, the best performing stock was Tesla. Technology, the U.S. is still the premier innovator of technology in the world. Some countries steal it, but we really originate a lot of technology, and that's where the growth engine has primarily been until recently in the stock market, has been technology. Now, the U.S. stocks have pulled back 20% this year, as Dwayne mentioned. The price to earnings multiple is about 19 times earnings in the U.S., and foreign stocks are selling at about half that, around 9 times earnings. So foreign stocks are super cheap. You have an underweight there, but as soon as things settle down internationally, I'm sure Dwayne will pick up the allocation to international. So I agree with his outlook at this time. I should show you in the book here some things that are noteworthy. Page 11. Now, the actuary, in order to help the city out, when you have when the numbers come in, good and bad, the actuary only takes 1/4 of the returns, because Patrick's picking up the prior 3 years. So there's a 4-year smoothing that goes on, both with gains and losses. You can see on the top of page 11 that the fiscal year to date return was minus 12.3. I don't know what it is today. I hate to say it, but you may be down 15%, 14% fiscal year to date. But Patrick is only going to capture 1/4 of that and pick up 1/4 of the big gain from last year in order to reduce the immediacy or the impact on the city. So instead of recognizing this loss in 1 year, this loss is recognized over 4 years. I should also point out that as much as we've talked about negative returns, one of the asset classes that you have here, Cohen & Steers Global Infrastructure, which is a deep value play, has held up pretty well. It's down 3.7 fiscal year to date versus the domestic equity blend here, which is down 13.7%.
Maybe another book. Hold on.
You're all with me on page 11?
We got that one. So yeah, we were looking at the book.
Yeah, it's up there. You can see the domestic equity 13.7 negative, and then the infrastructure plus 3.7 down below. So the 3.7 is an equity category that held up very nicely for you over the last 9 months. But anything that's related to equities, bonds, everything has been shot up in this market, except private real estate. Any questions? Markets go up, markets go down. The Fed is going to somehow slow this thing down. Regrettably, a lot of the things they're doing right now aren't really going to take much effect until next year. And because there's a huge lag here, whatever they do, you know, they throw the ball in the dark, they throw it for 50 miles, they're not really sure where it's going to land, have an idea where it's going to land. But could you throw the ball 50 miles? Or 50 yards? But they have lots of tools in their war chest. So if we reach a point, the economy appears to be stalling again, the Fed will undoubtedly lower rates again and enter the open market operations and become a buyer of mortgages and bonds again. So the Fed is trying to figure this out. I don't think they've ever been here before. This is all uncharted for them because of the magnitude of the nominal growth of the economy. It's amazing how much inertia is out there with this growth. It's very hard to slow it down. Any questions with that? If there aren't any, we'll go into real estate.
No questions.
Let's come back if you have questions. Okay, let's talk about this handout, the supplement that Jill's going to put up. We've been doing this a long time. We invest with about 5 or 6 of these firms. American is a firm that we've been investing clients with for many years. And the reason why I've waited this long is because these firms want larger mandates from these plans. And I've been able to get this company to agree if all 3 of these plans got on board. Actually, I'm sure just one got on board, they do it. But to take a smaller mandate. If you go to page 8, you look at the right click. You have to turn your head a little bit. Oh, that's good. That'll make it really hard. One more. All right, so we look at risk. One way we look at risk is in diversification is how are assets classes correlated. Private real estate, if you go from left, if you go to the left to the right, private real estate has a very low correlation to bonds, large cap, small cap stocks, and REITs. In fact, the correlation of bonds is negative, meaning that when bonds go down in price, REITs generally go up, or at least 20% of the time. 15% of the time, private real estate and the S&P move in the same direction. So, and only 9% of the time for small caps. So you can see there's a very low correlation there with the other programs in place. So that's nice to see because that's an illustration of diversification. Then if you go to the next page 9, the Sharpe ratio is really a measure of the returns per unit of risk. And you can see going back 20 years, the best compensation from a risk return standpoint has really been amongst these categories has been with private. And it's because the standard deviation of risk is so low. And you can see the blue dot there to the left above bonds. It's a higher return mechanism than bonds. We don't like bonds anymore, of course. We cut the allocation here considerably in the new policy. Higher return than bonds, a little bit more volatility. You don't get the risk and return of stocks, but we don't want to be like, we don't want everything to be in the stock market. So there's that stability that we're looking for. Then the table on the top there actually goes back 44 years and shows that for this length of time, most of the returns from private came from income. And that's rental income that's paid by tenants. It comes back to you. But in the last 5-10 years, the relationship between income and appreciation has been very similar. Then if you go to page 10, where do they invest this 8.5 or $6.8 billion? And it's 35% of it's in industrial, and that's essentially warehouses. Very hot area, remains to be hot. Residential, those are apartments, 27%. The office market, believe it or not, is actually coming back. People are going back to work again. And the retail market, believe it or not, is coming back. Simon Properties, which is the largest operator of malls in the United States, has been reporting very strong earnings. And you saw the reports the other day about FedEx. FedEx is really, they're telling people they're really going to miss on this year on earnings. The business is off in China and in Europe, but it's off here too. People are cutting back on their internet stuff. They want to go out and try on clothes again, try on shoes. They want to buy it again. They want to feel it, touch it, smell it. So all of those, the 4 major sectors are on the mend, doing pretty well. And as I said earlier, we like the fact that this inflation is not going away anytime soon. This is one way to play it, and that is to get into private real estate. Now, how do you get in? There are 4 windows a year to get in, around the first month following the end of the quarter. So the next entry point would be October 1. That's why we're kind of compressing this today, because if you want to do it, at least if you want to get in October, you got to make a decision today. Otherwise, you'd have to wait until January 3rd. So you have 3 windows a year to get in, and you have, 4 to get in and 4 to get out. So if you want to pull your money out, you give a letter of notice about 2 weeks in advance. Any questions? We have a real estate guru here, so I'm sure the mayor will have some questions.
Newcomb, you got questions? With the, so as it relates to, like, I guess we're looking at office. So with the change in the way companies are doing business now, changing their footprint as it relates to commercial office space, how does that impact the conversation on the private real estate investment?
That's a good question. A couple of things are happening. One, office buildings are being repurposed. I'm going to go to Boston and visit some managers in October, and I know there's a major office building downtown that's being converted into multifamily, into apartments. There aren't a lot of offices being built, although a major New York developer announced a huge project in Palm Beach West Palm Beach, where they're going to put up 500,000 square feet of office. People are coming back to work. There is a certain, the reality is that some companies need to have that while other companies don't, and they're going to allow people to work from home. So I think it's going to be a mixed bag. There is strength though in the office market. It's fairly new, but there is recent strength there. On the industrial side, I should mention to you that what's happening in Europe with the rise in energy costs is a number of companies in Europe are shutting down. And German companies, which are the main thrust of economic activity in Europe, they don't make aluminum in Germany right now. They've stopped making glass, certain types of glass, because of the high cost of natural gas and electricity. So what we're already seeing is European companies looking to relocate into the United States.
Yeah, I've seen that.
And that's where the industrial sector, that's one reason it's so hot. Now, if BMW wants to build another factory in South Carolina, it'll take them 5 years. They got to find the site. They got to get the permitting, engineering, all that'll take a long time to get that thing built. But this is happening right now. There is a lot of interest among companies in Europe. The Savannah port, which is the second deepest, it's the second busiest deep water port down in the United States. They're going to double the size of the port. We're going to build a big road underneath the city along the south side of the river. All of that. Kia is building a $8 billion EV plant in Savannah. All of that, they need infrastructure. They need buildings. They need warehouses. And so this is happening all over the United States right now. So that's another bullish signal, I think, for industrial. I think now that Putin has overplayed his hand now, he's played this game with, stopping gas and oil sales to European countries. This is the third or fourth time he's done it, but he's overplayed his hand. So reliance on Russia is going to fade here pretty quickly. Wait until this winter. You're going to hear a lot of horror stories about the lack of energy in Europe. And that's going to continue to, I think, accelerate this renaissance of industrial activity in the United States. Now, hopefully in Palatka. You want it?
We'll take it. It's been a conversation.
That's on my remarks. Do you have any more questions?
No, I agree. We're seeing more trends of less reliance from the United States on international products from before, during the mid-peak portion of the pandemic. And so I've seen some of the reports where factories are changing products that they're manufacturing to kind of meet the voids that are out there that come from reliance on China and some of the other European products as well. So
You're following this China thing. It's serious.
yeah, and so there's been an intentionality in reducing the amount of reliance, particularly with just the difficulty in getting things back into the country. So.
You okay? I almost put you to sleep there. I apologize. I tried my best to keep you awake there. You came back quick. But if you want to do this, the motion for consideration would be to proceed with retaining American Realty Advisors and to allocate a 7% position. And that would be funded from bonds and cash.
Okay, so you've heard the recommendation from BCA.
Yes.
At this time, is there a motion approving or modifying the recommendation?
The recommendation is all for.
No, it's for the blade.
So that's a good question. glad you asked that. If you look at the portfolio overview, you're investing in a pool. It's about $7.8 billion pool. There are there are 82 different investments in it, buildings, apartment complexes, whatever, warehouses. And you're investing in this, you have an undivided working interest in all of those properties. You're in there with everybody else investing in the same stuff. And that's how it's broken down into those diversifications of 5 different property types. I left one thing out too. I know we've got the motion out there, but the leverage ratio is 18%. And what that means, it's like you buying a house and only financing 18% of it and putting the rest down. There's a very low leverage proposition here. I don't like a lot of leverage, so this is a very conservative way to invest in commercial real estate.
Okay. Haven't heard that. Is there a motion?
Make a motion that we go along with or that we adopt the recommendation as proposed. Second.
There's a motion on the floor and a second to accept BCA's recommendation. Is there any further discussion on the motion? Hearing none, all in favor, say aye. Aye. Opposed? Motion carries unanimously. Thank you. At this time, I'll entertain a motion to accept BCA's report.
Motion to accept the report as presented. Second.
There's a motion on the floor and a second to accept the quarterly report. All in favor, say aye.
Aye.
Opposed? Motion carries unanimously. All right, next up is Klausner.
Hi, everybody. I just want to make a note that based on Burgess's recommendation, I did go ahead and work with the ARA legal department to get the side letter in order. There was a lot of back and forth, but we are happy with the end result and feel that you're adequately represented in the side letter. So we are happy with that and feel confident with you all moving forward.
Okay.
And that is it for me, unless anybody has any questions.
Anna, we're going to be voting on the actuarial agreement that you put together, the addendum, because it had the incorrect.
Okay, yeah. Just a quick update. This one agreement had an incorrect fee agreement amount. We confirmed with Patrick, and this is the correct amount. So it's just going to be revoted on to accurately reflect what's in the agreement.
Just for the record, go ahead and indicate what the modification was compared to the previous.
Jill, do you have that in front of you?
I don't. I only have the current. What it was attached in Exhibit A were the fees for the fire department, the firefighters pension fund. And I believe it was the standard annual valuation was one of the ones that were going to be more expensive for the police than the fire.
So
And
the
it's-
11,312 is the accurate figure.
Yes.
So
I can pull it up one second. It was previously listed as 8,568.
can you repeat that one more time? I'm sorry.
Yes, it was previously listed as 8,568.
So what's the basis for the $3,000 difference?
Patrick would have to tell you why there's a discrepancy in the fees. It could be size or just amount of work. I don't, I don't want to speak for him, so I'm not sure why there is that difference between the two funds. There is also a difference with the general employee fund as well. So I think just based on the scope of work, the amounts differ for whatever reason. I'm happy to ask him if you would like a explanation.
Yes.
Okay, not a problem.
Any other questions? All right. Entertain a motion. What's the pleasure of the board at this time? And quite honestly, I think that his answer to this question is critical.
I will say there are more people contributing to the valuation report because the valuation report takes in everybody in the police department currently, everyone who's left the police department during the year, and all the retirees. And the retirees alone are double, as well as the employees double than the fire department.
Okay. Any questions? Either newcomer Max? All right. So what is the pleasure of the board at this time as it relates to approval of the fee and the addendum?
I would just like to hear what Patrick says the actual reasoning is before we make a motion to accept it.
Okay.
These fee, this was approved at the June meeting. But then Anna realized that she had the wrong fee structure on the agreement.
Yeah, nothing, excuse me to interrupt, Jill. Nothing has changed. He didn't go back and decide to increase the amount. This was the amount that was proposed and voted on at the prior meeting. It was just incorrectly reflected in the final exhibit of the agreement. So we are just sort of correcting a housekeeping error. But the amount, yeah, already voted on.
And the new fees go in effect October 1st. So we won't have a meeting until December 13th. Yeah.
So we would just be correcting a typo basically in what we had already voted on before.
Yes.
Correct. I can still get an explanation as to why.
Yeah, I still like the explanation as well.
That's fine, but nothing is nothing changed in between the two meetings. Just want to make that clear.
Motion to accept the corrected fee structure report.
There's a motion on the floor. Is there a second?
I'll second it with the understanding that Patrick's going to come back and tell us what's going on. Yes.
There's a motion on the floor in a second. All in favor, say aye. Aye. Opposed, motion carries unanimously and reluctantly. So, thank you. Is there anything else from Klausner at this time, council?
That's all.
Okay, thank you. We'll pull up quarterly expenditures. And our next item, Ms. Kaiser.
Yeah. Yes. The expenditures, nothing really unusual. Again, some contribution refunds, but no unexpected. If you notice the pension payment that June 22nd, June 2020 retirees pension payment, the final line there stays pretty consistent. That's going to change in October because of the increase to the pensioners that the actuary presented and it was voted on the prior meeting. So that would probably be about $1,000 higher.
Okay. Any questions on the expenditure report? If not, I'll entertain a motion.
Make a motion to accept.
Second.
Motion on the floor in a second. All in favor, say aye. Opposed, motion carries unanimously. We're now open the floor for public comments. Public comments will be limited to 3 minutes. No action will be taken on topics of discussion. Is there anyone here for public comment? Please fill out a speaker's card in order for you to be heard. Seeing that there's no one in the room, we'll take it that public comment is closed.
Other business. I have an item on other business. It is not, it's more informational, and I left on your desk a copy of some dates for the calendar year 2023 that I've approached Dwayne and Burgess and Patrick about. This is a result of meetings being held at the last 2 weeks of a quarter, and when there isn't a quorum, it's very difficult to schedule another meeting within the quarter. So the attorney has suggested we move back dates, work with them on trying to find dates that are moved back some, especially with the new real estate investment, who needs a 2-week window before the end of the quarter. So that's another reason to push back dates some. This is just informational at this point because these dates will come up in December meeting to be voted on. But if you have any major concerns with these dates, please contact me, and because these dates are for all the pensions. And that's it.
Okay. If there's nothing else before us at this time, without objection, we'll stand adjourned.